So one of the most frequent questions I get is, how do you know which contracts to pick when you're trading options? In today's video, I'll be talking about how to find the best options to pick for options trading. Now, there's a lot that goes into just picking a specific strike price. But before we go ahead and get into how to pick an option, let's understand what an option is. First of all, when you go on the internet and try to search up the definition of options, it's like rocket science. I remember first starting going on Google and YouTube. Luckily now there's a lot more educational videos on the internet. But to put it in simple terms, because anybody can go on Google and find the general definition of what contracts are the right but not the obligation at that strike price to purchase those shares. For example, if you let your contracts expire on Friday and you have enough money in your account, you can end up executing those options and own those shares. Now, do a lot of people do that? No. Do I do that? No. But it is a way to trade options, and a lot of hedge funds and institutions use options to their advantage because of that, and also hedging. Now, one option is equivalent to 100 shares. Now, that's also why you get, really nice multipliers. For example, you can easily make 10% on a $1 move on Tesla versus owning one share of Tesla and, making $1, right? So understanding that options is a tool to make more money is a big thing, and understanding that there's a lot more risk that goes into options, especially as you get closer to expiration date. So we'll talk more about that. But first, you need to understand how much you can lose in an option. Now, if I buy one contract of Tesla, 180 calls, for example, I'm giving you random numbers, and they cost $300 per contract. The most you can lose is $300 if you let them go to zero. They cannot go negative. So first of all, understanding that. Now, there's a lot of other ways where you can end up, shorting some contracts. There are a lot of different, option strategies. For example, Iron Condor, Butterfly. There's a whole lot of other strategies that people use, and we'll talk more about that. I'll make more videos for you guys. But first, we have to get to the basis of what options are. The next thing is, what is Delta, Theta, and IV? Now, I've talked about this previously. Delta is how much you can make per $1 move on the stock. So for every dollar move, Delta will tell you how much you'll make. Now, let me show you where you can find that. You'll go here, you'll go to the option chain on any platform that you're on. You have to either add it or it'll be there, and it'll show you Delta. For example, here it says 60.62, which is 62 cents. Now, that is equivalent to $62. For every dollar Meta moves up on these calls, you'll make $62 per contract. Now, I'm not a fan of you guys looking too deep into this, because you guys are going to start judging your plays on how much you can make. Okay, I need this to move $5 for me to make $400, for example. And you're going to try to hold those $5 to make the $400 because you've done the math on the Delta. Delta is not meant to be used for that. Delta is to show, or to be used in a way where, is this worth the trade or not, right? If I have a target of 622 and Meta's at 620, it'll show me how much I'll make per dollar move. So I'll understand what's my reward versus risk on these contracts for that price target that I have for myself, right? That's the way to use Delta.
If you're serious about learning options trading this year, but can't afford to take any risks, then I have the perfect challenge for you. Moom's Options Paper Trading Challenge. Here's how it works. You'll be given $200,000 in virtual funds, pretend cash, to trade options in a simulated market. The challenge is going to run from January 13th to February 7th, and the whole goal is to get the highest returns in virtual trading. The winners will share $15,000 in prizes. The top three will either snag a MacBook Pro, an iPhone 16 Pro, or an Apple Watch Series 10. You'll obviously gain access to all of Moom's pro level tools, advanced option strategies, and free option investing courses to help you with your investing. It's a sweet way to get serious about option trading without any risk to your budget. Hit the link in the description or scan the QR code right now to join the challenge.
Now, the next thing is, how do we know what Delta is without looking at it? For example, in the money contracts, Delta will always be above $50. At the money contracts, Delta will always be at $50. Out the money contracts will always be less than $50. So understanding those three rules right there. Out the money, means delta is less than $50. At the money, delta is at 50, and then in the money, delta will always be over. For example, let's go ahead and look real quick. The 620, it's at 626 right now. The 630s have a delta of 42. The 627.50s, which is slightly at the money, it's almost at the money, they're at 49 cents, which is $49. And then in the money right here at 625, these are $55. That goes for all contracts. The next thing you need to know is what theta is, right? Why do my contracts lose value throughout the day? Well, theta is one of the reasons, then we'll talk about implied volatility, but theta shows you how much your contracts will lose per day, even if nothing happens. If your stock stayed here at this meta stock stayed here at $626.72, your contracts will still lose this value in 24 hours or for the day. All right, that's $168 per contract, and these contracts are $570. That's a very big chunk. So a lot of people ask why I don't stay into these trades so long. Well, why not take my 25% trade? For example, today I call a 36% it was a pretty big trade, a 30-something% trade on Tesla. I could have held it a lot longer, but it was the fact that I looked at data, I looked at where we are in the market. I don't feel like it's worth the risk for me to stay in this consolidation where I can end up losing the value on my contracts, plus it might not go my way. So there's so many things to look at, especially when I'm looking for longer trades, and theta is definitely one of them. So that's how you use theta, right? This will tell you how much you'll lose per contract every day if it stays in the exact same area, right? Now, remember, stocks move up and down. So yes, it can consolidate, but for the most part, the stock will decrease, right? If let's say you have calls and the stock drops, you will no longer just lose this, you'll lose that, plus, the equivalence of what's going on with implied volatility, how much you're going to lose per contract, and then theta is something that just, it's just a cherry on top for how much more you're going to lose on your contracts. Now, the next thing you want to look at is implied volatility. What am I looking at when it comes down to implied volatility? A lot of people are very confused. So if you go online and you try to look at the definition of implied volatility, it'll look like rocket science. Again, so let me simplify this for you. Implied volatility could be used as another saying for expected move for the week. So every week on a Monday, Tuesday, Wednesday, Thursday, Friday, I'll look at IV. For example, I'm looking at IV for these contracts on Meta. For the rest of the week, these are at 33%. Now, how do you determine if these are too high, too low, right in the middle? You have to pay attention and get screen time every week and understand what's the average implied volatility for Meta, Tesla, Google, Amazon, whatever stocks you like to follow. But what you need to understand is just because Meta's implied volatility for the week is 33%, and then I go to Tesla and it says 69%, that doesn't mean Tesla has high implied volatility and Meta has low implied volatility. It has nothing to do with each other. There is no correlation. Implied volatility is strictly based off your contracts for that specific stock. So 33% can be very high for Meta. The average for Meta can be 12%. For example, let's say the average 10% return you get on Meta is for every $1.50 it moves, right? If implied volatility is too high that week, it'll take $2.50 to get that 10-12%, right? That's why we have to pay attention to implied volatility to see if it's worth me even trading the stock. How much do I have to basically, accustomed to as far as the move? How much does this have to move for me to return, the amount that I'm used to, which I'm looking for 10 to 12%, for example, right? If implied volatility is too high, it may not make the most sense. That's why during earnings week, I tend to not even touch any stock that has earnings that week. Why? Because expected move for the week is too high. When stocks have earnings that week, the expected move is obviously what is it expected to do that week. And if they have earnings, they're expected to move a lot on earnings. So during that week, it makes no sense for me to take a trade on it because instead of getting a 10% move on a dollar move, I'll need $2.50 to $3 to get 10%. And that's if you're lucky. The Tesla on earnings week and stocks like Meta and Netflix, all those stocks, you need crazy moves during that week to get nice returns, especially when it has earnings. So implied volatility is a very important thing to pay attention to. It is all based on the correlation of that specific contract for those stocks. Do not try to compare it to other stocks, right? If you look at 33% on Meta and go to 66% on Tesla, that doesn't mean one is high and one is low. It's based on what you see on an average every single week. So for example, if Tesla has an average implied volatility of 60% every single week, and 1 week it's at 80%, then implied volatility is high. Expected move for the week is higher than the previous week, right? That's something to be careful about, because throughout the week that will decrease because we get closer to expiration. Now, the next thing we want to talk about is volume and liquidity, right? What is volume and liquidity? Well, each contracts offer or show you volume, right? It shows you right here in this column. Volume is showing you how many contracts were traded during this specific day. So today, Wednesday, January 22nd, on the 640 calls on Meta, there has been 14,638 contracts traded, bought and sold. This is not showing you how many were bought or how many were sold. It's both, right? Bought and sold. For every buyer, there has to be a seller. And for every seller, there has to be a buyer. That's just how it works, right? 14,640. Now, what do we want to pay attention to? Just like a stock, we don't, or for example, I don't trade penny stocks because there might be, an issue with liquidity. Can I get out these shares when it's up this much? Or can I get out these shares when I'm up this much? Same thing with these contracts. If the liquidity is low, or volume, you can call it whatever you want, then it's going to be very hard for me to get filled at the highest price. Now, can I get filled? Most likely, yes, even if the volume's low. But I'm going to get killed when I go to sell that, because I'm going to be selling at the lowest possible price, which is at the bid, and maybe even below that if there's too many contracts for me to sell. For someone like me who's trading hundreds of contracts at a time, especially when they're cheap, right? I need to make sure there's enough liquidity for me to get out. Right? You know the jokes online about crypto, you're my liquidity. Yeah, I need to make sure that I have enough liquidity to exit my contracts, right? For you guys, why does it matter if you're not trading a couple hundred contracts? Well, the more liquidity or volume that you have, the tighter your spreads will be. What are spreads? The spread is the difference between the bid and the ask price. Transactions are going on between these two and at the ends, right? Now, you don't want to get filled at the bid because that is the lowest price you'll get. And it's like, instead of getting 13% where you see your profit is at, you'll get 9% because you're selling at the very bottom. The wider the spread, the riskier the trade becomes, because now if the trade doesn't go your way, forget about being in profit. If it's not going your way, not only are you going to be down 20% when you're wrong, you're going to be down an extra 6, 7, 8% if the spread is wide and you can't get filled. So the liquidity is very important for you guys, even if you're not trading a couple hundred contracts at a time. That's why I have to pay attention to that. Tighter spreads you get with higher volume and liquidity, and very easy exit. As soon as I press that sell, it'll fill me. And it's very nice when you have a good platform, because if liquidity is high, you'll most likely get filled at the ask or very close to the ask if you're selling in the direction that it is going to. Do not try to wait for a pullback and then try to sell and expect to get filled at the ask. No, why would it do that? If you're in calls and it pulls back, then obviously price is going to pull back, bid is going to drop quicker than the ask, and you're going to get filled at the bottom of the barrel, right? You need to understand those things. Volume and liquidity. Now let's recap what we just talked about, right? What are contracts we talked about? How much you can lose, delta, theta, implied volatility, volume, and liquidity, right? The next thing I pay attention to is I identify strength and weakness in contracts. Now, that might be a little confusing to you, because you might say, well, that's not the stock. Why are you paying attention to strength and weakness in options? Well, let me explain to you. Stocks get very volatile, right? And some days options get very volatile because of the types of days we've been getting in the market. Now, the one thing I want to pay attention to is how much is this moving when this has a pullback? If I'm looking at calls, if I'm looking at puts, what happens if I'm in puts and this bounces? Let me see what's going on. Does it hold up in value, or does this get extremely cheap in a matter of seconds where I can lose 30% off of one simple bounce? If that's the case, I need to see, okay, that's may not be worth the trade that I was looking for, right? And I pay attention to those things because I need stocks that show stability, right? I need contracts that show me stability. Same thing with stocks. Yes, volatility is great, but you still need stability in some aspects. And that one of those specific aspects that I really, really like is options, right? And when I watch these options stay stable, then that shows me, okay, I've planned out my trade. This is how much I'm expected to make. This is my target. This is my stop loss, right? Blah, 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 blah. And then, okay, are there any added red flags? Now, if I find stability in these contracts when there are bounces and I can determine that, okay, yes, this is what I expect to lose at this given moment in the stock. If this bounces, then perfect. But if I see that there's no stability in these contracts when something happens, then I need to pay attention to that and say, okay, either it's not worth it or I need to go in far lighter than I expected. Because for me, let's say my average position size for quote unquote is 50,000. I was only expecting to lose 10%, which is 5,000. But these contracts are showing no stability. And this little bounce already took 16% off. And my stop loss was supposed to be a little bit higher. Now I have to say, okay, for me to lose 5,000, how much do I need to decrease my size by? Right? And those are all little things I need to pay attention to. So that's why strength and weakness is a very big thing. Now, the next thing is, are these contracts expensive or inexpensive? Everybody's going to say, is it based on the price, right? Oh, contracts are $900, they're expensive. That is not how I determine what expensive or inexpensive things are. Everybody's going to say, well, you can just look at the price of the contracts. That'll show you if it's expensive. That's pretty easy. If it's $900, it's expensive. It's $400, it's cheap. No, that's not how you determine if something is expensive or inexpensive. How you determine if something's expensive or inexpensive is it's only expensive if its value is absent. What does that mean when it comes to contracts? If the value is absent, then it's expensive. If the value is there, it's inexpensive. So if these contracts are $900 and I can get a quick 10%, if the move makes sense where the returns are beautiful or give me or show me that, okay, even though these are $900, if I get a 50-cent move or a dollar move, these are going to pay me 10%. And this stock is moving $3, $4, $5 at a time, then they are inexpensive because the value is there. Get it? Now, if these are $900 and the returns are terrible, then it's expensive. Example, I said I do not trade stocks during earnings week. Why? Because contracts are expensive in price and have no value for me to trade them. Because on the move that I usually take for, let's say, a $2 move, $2.50 move, instead of me getting 10%, I will be getting 4%. That is the definition of expensive. Now, the first thing I want to do is compare expensive or inexpensive thoughts or ideas that I have to previous weeks. So all I have to do is go to previous weeks. Okay, these are usually $800. Now they're $900. Are they showing me any value? And that's where I'll determine if they're inexpensive or expensive. That is one of the biggest rules when it comes down to trading options. You have to always find red flags. It's not all about how much can I make. It is a very big part of how much can I lose and is there a reason I should be trading this? Don't trade stocks or options to gamble. Always have an advantage. If there's no advantage for you, it is okay to sit down and sit there and watch and understand how options move, and it'll set you up for a better trade on a different day. Now, the next and final main or serious step is finding out how much does your stock move on average. Now, this is where you go from the options chain, and now we can go to the stock and have a little bit more fun because this is where you guys like it, right? You guys want to get straight to trading options, we have to go to the chart on the final step. Now, what are we doing on the final step? We need to see how much does the stock every single day move on average, right? And why does that help? Well, that'll help me determine how far out the money or in the money or at the money where should I buy my contracts, right? That'll determine exactly which contracts. Now, one thing you have to understand is as we go throughout the week, your contracts become more riskier. I trade weekly contracts which expire every Friday. Now, you can buy 2, 3, 4 weeks out. You can buy months out if you want to. But if I'm buying same weeks, and I'm going to base this off myself, I'm going to talk based on myself. Monday, you have 4 or 5 days before they expire because they expire Friday. Tuesday, you now have 3-4 days. Wednesday, you now have 3 days, 2 days. Thursday, you only have 1 more day. As the week goes on, your contracts die in value. Why? Let me put this in real life perspective. How can we do that? Let's say you're trying to get life insurance at the age 60. First of all, you may not even get approved. And second of all, you become high risk and they will be extremely expensive because you're on your way out. Let's put it like that. If you try to get life insurance at the age of 18, everybody wants to jump on board. Why? Because the potential of your lifespan, the expectancy, is another 60, 70 years. At the age of 60, you might only have 10 years left, right? Low risk when you're younger, lower risk because your health is still there, you're still fit, you're still healthy, your knees still work, right? And you have no previous health, injuries or health issues that the insurance companies say, okay, you're worth this much and you're this expensive, right? Then you come back again, let's say you didn't get at the age of 18 and you try to get at the age of 60, you're too risky, you might die soon, and your knees aren't working and you have previous health issues that we've seen in the hospital. You're very high risk. We're going to either decline you or this is what you're going to deal is, and it's going to be a very terrible deal for you. You have to expect or compare things to real life scenarios so you can understand them in your head. Same thing with contracts. As the week goes on, let's say our contracts are 650s on Meta. It's Wednesday, almost the end of Wednesday, right? We're at 625. As time ticks, it becomes more impossible or very low probability that our stock will end up at 650 or in the money by Friday. So our contracts will continue to decline in price or value, we can say, right? That's one thing you need to understand. The next thing is Monday, I can go a little bit further out the money because the risk isn't as high as buying out the money on Thursdays or Fridays because I still have plenty of time for my stock to get to that price point. So these are serious things you need to understand, right? Tuesday, it becomes less time. So then I will lower the amount I will go out in the money, right? You guys get the gist? Now, I also want to know how much this is move on average every day. For example, today this off the open dropped down to 619 and pushed up to 633, right? That's about what? Let's say a $13 move. So that's $13. How much did it do it yesterday? And then I'll go for the past weeks. Let's say the average move on Meta is $10 a day. Now it's Monday, right? And this stock is at 620. I'll buy the 630 calls because I have plenty of time, right? And it's not unrealistic, right? We have plenty of time till Friday, which they expire, which is the death we can compare it to. And this is a stock that moves on average $10 a day, right? Get where I'm going with this? Next stock, let's say Tesla moves on average $20 a day, right? Then look at this. Look at the bottom here at 416, 428. Well, today it moved $12. But the range, let's say, is $20. On a Monday, I can buy, if this stock is at 420, I can buy 430 calls, 440 calls. Now, as the week goes on, just because the range is $20 doesn't mean I continue to buy those same out the money contracts. The risk becomes higher because if the play doesn't work out, they will drop in value very, very fast. And it becomes a risk that isn't worth taking on your trade. So what I'll do throughout the week, just because let's say the average is $20 range, I will drop it down to $10 out the money on Tuesday. Then Wednesday, I'll keep it at $10. Thursday, I'll drop it down to $5 out the money. And then by the end of Thursday, I'm either at the money or in the money to keep my risk at a minimal. These are all important steps and all the tools you need to pick the correct contracts. For example, I'm going to tell you my exact play today on Tesla. I played this exact breakout right here. I'll zoom in for you guys. This 420 break. What contracts did I buy? The 430. Why? Because this on average it moves about $12. So I use the $10 range. It's still Wednesday. I still have another 72 hours. It was the morning of Wednesday. So I technically have 3 days left before they expire. These went from 420 to 425 or almost 425. I made about 36% on that trade. Now, if this trade was tomorrow and I took this on Thursday, I would be buying the 425 calls. And if this was on Friday, I'd be buying the 420 calls, which is right at the money or even in the money during that day. I hope you guys enjoyed this video. You guys have been loving these educational videos. If you guys enjoyed it, make sure you hit that like button, subscribe, turn your notifications on because I have plenty of videos that'll be live soon. And I'll see you guys on the next one. Peace.